You may have heard that purchasing with residential financing with a AAA bank is the way to be able to scale a rental portfolio. Well, in today's market, we're here to tell you that people are having challenges and there are other ways to bash through that glass ceiling. In today's video, we're going to discuss commercial financing, how to utilize a strategy to be able to scale your portfolio, and what to look for when looking to take advantage of current changes in today's market. Stay tuned. Hey guys, Josh Ehren from the Findlay Mortgage team, and in today's video we're going to discuss the residential glass ceiling. As many of you know, scaling on the res side has been something that most investors have been doing over the last 3 to 5 years, and it was decently easy for a prolonged period of time while capital was cheap and rents were able to support the debt that was on these properties. Needless to say, we're running into some challenges. Most people, what they were doing is they were looking at typical conventional A lenders and they were purchasing properties that had zero impact on them. Now, these zero impact properties essentially mean that they're washing their debt, meaning half their income on the property was supporting 100% or more of the mortgage payment that was on this property. This would allow you to be able, as an investor, purchase additional properties without having the negative impact of the properties you currently have. This strategy was phenomenal and worked for quite a long time as capital was cheap, but currently right now we're seeing some challenges in the market. We wanted to make a video specifically discussing how people in this market can continue to buy real estate without necessarily needing to focus on the AAA banks.
Yeah, even with the rise in rent, the rise in the rates, and where the price of properties are at, when we're taking a look at trying to debt service those properties and cash flow, it's just not quite there enough on these lower unit type properties. So that's where we want to just take a look at some of these other products that are out there to give you guys more options to be able to continue to buy and continue to scale your 1 to 4 unit and above, but specifically kind of focusing on these ones on that 1 to 4 unit portfolio. One of the first things we want to talk about is structuring your purchases with specific lenders for specific purposes. So what I mean by that is when we're taking a look at the process of going through a BRRRR strategy, your acquisition debt is your cheapest debt because you're going to have your lowest mortgage amount. Your exit financing, or that repositioning financing, that's going to be your most expensive debt in that sense because your mortgage is going to be a lot higher than what it was, or ideally a lot higher than what it was on that acquisition. And even throughout that process, your rents, obviously, when we're taking a look at qualifying the property on the purchase versus qualifying the property on the take-up financing, aren't going to change enough to be able to help you really afford that exit financing. So the strategy that we're taking a look at is acquiring your property with either like an A or a B lender to kind of give you the cheapest term debt as you're going through and repositioning your property, doing any of the renovations, finding tenants. And then on the exit financing, taking a look at using one of our small commercial tools to be able to help you qualify on that exit financing. The key here is that when we're taking a look at the small commercial financing, our small commercial lenders are not as concerned with your personal debt ratios as would a residential lender such as like Scotia, TD, First National, MCAP, these A lenders. Small commercial financing is really just taking commercial financing and applying it to a smaller building. So what we're doing is we're taking a look at the gross income minus your gross expenses. So again, we're going to be taking a look at your utilities, your insurance, your property taxes, a vacancy, repairs and management, repairs and maintenance, and a management cost. That's going to give you your NOI, so your gross income minus your gross expenses, and then we're going to take that NOI and we're going to divide that out by your annual mortgage payments. And ideally, when we're taking a look at this debt servicing based loan, that's going to give us into our 1.15 ratio and allow you to qualify with a commercial lender and not have to worry about your debt ratios with a bank lender.
Yeah, so essentially what's happening is people aren't able to qualify using their personal debt servicing ratios at the moment. The strategy here would be, if you do have the ability to purchase with an A lender, which is phenomenal, then do so, or if you don't, then utilizing the current cash flow or the current rental income you have with a B lender. A lot of people forget that this B solution using an offset instead of an add back is extremely advantageous, especially if you have properties that are working like okay. Essentially meaning by okay is is if you have a property that is essentially cash flow neutral at the moment, a regular bank would take 50% of it, add it to your gross income or deduct it from your expenses. But B banks will take 80% of it, meaning they're taking off a large chunk of your carrying cost on these assets, and you're going to be able to purchase more than you would normally with an A lender. Now, the thing is with a B lender is it costs a little bit more, but they allow you to have higher ratios, and they allow you to be able to be a little bit more creative when it comes to acquiring these assets. The reason why you would use a B lender is because you can utilize the rental income in your portfolio, but you can also close in a corporation. So essentially the strategy here would be closing a corporation, utilizing the assets you currently have, come to us and we would be like, you know, this is how much rental income you're going to need in this fourplex to be able to service your as complete value when your project is complete. Transition into commercial financing with this once your project is complete, and that would have zero impact on your personal debt servicing ratios moving forward to acquire more assets. This strategy has been implemented when capital was cheap, and it's still being implemented now when capital is expensive. The important thing to understand with this specific strategy is it's infinitely scalable if you do it correctly and you do it properly. Now, geographical location has a huge impact to play on this because you're going to be capped by the type of financing you can have or the type of lender who's going to finance you. So, I mean, you have definitely more options if you're in the Golden Horseshoe, if you're in decently populated areas with at least 50,000 people. If you're looking at Timmins, or if you're looking at Sudbury or even Windsor sometimes, it can be a little bit more challenging to get that commercial financing at the terms you're looking for. So if you are looking to execute in this strategy, just understand the location is going to be a huge impact on how you're going to, on the success of your actual purchase or your project.
Yeah, something to consider when we're taking a look at the structure of a small commercial loan. You're going to be limited to a few things. Your loan to value is typically 75% loan to value. Your amortization is usually 25-year AM. The rate itself is actually pretty similar to some of the B rates that we have right now. So B lender rates, you can be anywhere from 6.6% up to 7%. On the small commercial side, you're kind of in that similar range. You're anywhere from like 6.5 to maybe high sixes. Again, depending, like Josh said, on the area that you're going to be lending in. The lenders do take that into consideration. So when we're comparing, the small commercial versus a B lender, again, the biggest difference and determining factor is going to be your personal debt and your personal affordability. When we're taking a look at it, B debt is actually a little bit cheaper than what a small commercial financing is going to be, just because you can get that 30-year RAM. That 5 years difference at that same interest rate is going to cut your monthly payments by a little bit. So that debt is going to be a little bit cheaper. But again, the determining factor here is what does your personal debt servicing look like, and what are you going to be limited to in your qualification. The fees, when we're taking a look at fees of an overall transaction, the small commercial lender is still going to charge you a fee. You could be anywhere from 30 basis points to 1%, depending on, again, where the loan is and the size of the loan, how complicated the structuring is. Your broker fees are typically the same on each transaction, so you're going to be around the same cost of borrowing when it comes to the fees. But again, the amortization is really just the biggest difference, and I guess the loan amount, you might be able to get a little bit more in a B lender versus that small commercial. But again, we're really taking a look at your biggest determining factor, which is your personal affordability, which is huge on the residential side. I mean, that's really the key factor in how we determine the success of a loan. If you can't qualify personally, we have to shift that focus over to the small commercial lending. Now, that doesn't mean that we forego everything. We're still taking a look at your credit score. The lender pulls your credit, so they have an idea of what your debt facilities are and what your monthly cash flow is going to be. You still do have to prove to a lender that you're in a financial position to still be able to afford your debt. So if you have a primary residence, you have a car payment, you have some credit card debts, maybe you have some other rental properties, a lender still wants to make sure that you're in a position to be able to afford this. They may ask to see, your other rental portfolio and what is your, portfolio debt servicing from that situation. Maybe they want to have an understanding of what your income is. Again, they just want to make sure that you're in a position to be a landlord. If your boiler goes or water, a furnace or roof or something goes on your property, you can't wait 2 months for rent to come in to be able to, replace those things. You have to be able to price them right away. So it's just the due diligence that the lender's doing to make sure that you're in that position.
For sure. And you know, I know a lot of you are thinking, well, how do I do this? Like, what areas do I look at? Where do these numbers work? I look at all these MLS listings and none of them work. You know, a lot of these solutions are working in secondary markets right now. They're working in markets that are about 30 minutes to 25 minutes away from a major urban area. You know, you're talking the St. Thomases of the world, the Chathams of the world, you know, anything outside of in between large areas. What we're looking for is multifamily real estate, small multifamily real estate. The more income that you can derive from a project to be able to increase your net operating income, the better off you're going to be. So most of the time, the solution is going to work with a triplex or a fourplex. If you can acquire some sort of vacancy on possession, that is the most ideal. And what you're going to do is you're going to come to us, you're going to say, you know, this is my estimated as complete value when the project is complete. We're going to reverse engineer the numbers based off today's market rate, and we're going to let you know exactly how much net operating income you're going to require to be able to service your equity takeout on the back end. It's extremely definitive, and a lot of investors like this because essentially the numbers are up in front of you. Can I get this market rent for this specific type of unit over this period of time? If I can, the numbers are going to work. I'm going to be able to pull my capital out and I'm going to be able to move forward. A lot of the clients that use this strategy over the last 2 years or 3 years are in a very decent situation right now where they're not over leveraged. You know, their assets, you know, if they were on variable terms, are still cash flowing because they had the requirement of that 1.2 or 1.15 debt servicing when they acquired the asset or they refinanced the property. This allows you to have a very healthy portfolio as you continue to scale. But it also allows you to be able to focus on really good assets that are going to continue to be strong throughout different market cycles as well.
Yeah, an important part there is the commercial financing focuses on cash flow. So, you know, there's all these different types of investors out there. Obviously, there's guys that are focusing on just appreciation, and then there's some guys that, you know, want that monthly cash flow. If you're a monthly cash flow type guy, these small commercial financing products are going to be your bread and butter because it forces you to have cash flow in your property, or else the lender isn't going to be giving you that loan. You know, you have to be at that 1.15, 1.2%, or you just don't qualify. So if you're looking for a loan that's going to guarantee you over the course of 3 to 5 years, you're going to be making money on this property, that's your small commercial product. Now, you may not be getting your maximum loan takeout. You may not be at, you know, 80 or 75% even, you know, depending on the cash flow. You might be closer to 70, 65% again, just depending on how the factors add up. But if you're just specifically looking for cash flow, these debt servicing loans are going to be, you know, the way to go.
Yeah, you know, I usually take a look at the United States and try to figure out, well, what are they doing? Because they're probably a year ahead of us. And we're seeing a huge resurgence of these types of loans. A lot of lenders are focusing on this as a way to be able to, you know, still disperse capital, but disperse capital in a way in which it makes sense. You know, I foresee a lot of the financing moving forward for investment real estate to be focusing more on this type of underwriting moving forward as you start to see OSFI, you know, project, you know, tightening up in regards to allowing people to purchase rental properties in the personal name. You know, it may be getting more difficult to be able to do this on the residential side if they decide to look at your personal ratios in a different light in the next 12 to 24 months. And if that's the case, how do you scale, or how do you purchase real estate in a way in which, you know, is going to allow you to reduce your risk, but allow you to also continue to do this in a way in which, you know, is going to allow you to grow? I think this type of financing segues well into, you know, what we're seeing overall in the market. You know, most investors, their income isn't increasing at a high enough level to support the current debt that we have on these buildings. You know, as interest rates increase, the carrying costs increase when you're looking to acquire or you're looking to reposition, and most people don't have the ability to be able to service it from the personal side, and that's why, you know, our relationship with our credit unions and our relationships with our commercial banks we're working with, those have definitely strengthened over the last 12 to 24 months because we foresee that this is going to be a consistent theme moving forward.
One other point that we want to just bring into the conversation is also just in regards to, you know, Bill 23 and the allowance now of up to the third additional unit. When we're taking a look at, you know, things such as like a garden suite and some laneway homes, one thing to keep in mind is not every lender and bank lender is on board with financing or giving value to these outbuildings. So, in the past, we have had some issues with garden suites and not being able to get the full financing, or even lenders wanting to put financing on these projects, these types of properties. And that's where these commercial lenders come in, and they allow you to have the value given to these additional buildings, because they're taking a look at it from an income approach. So if you're, let's say you've bought a building, and I've actually had a scenario in this in the past where a client bought a single family home, they did duplex conversion, so we put traditional financing on the duplex conversion, and then after that refinance, they took the proceeds to build a garden suite. The bank wouldn't then refinance the property again with this additional unit on there, the garden suite, so we had to take a look at going to a small commercial lender. Small commercial lender gave value, and actually a really good valuation to the whole property because of the additional unit. So again, the commercial financing can be a great option if you're suffering from personal debt issues, but it's also a great option if you're looking to take advantage of this, third unit, these ADUs, laneway homes, garden suites, whatever you're looking at adding on to the property. A great option.
Yeah, phenomenal option. I think that, as we start to see investors try to find ways to cash flow in a market that doesn't have any at the moment, we're going to start seeing a lot of people either look to create these garden suites or look to create these laneway houses. And as you said, the legislation's there, but the banks aren't on side at the moment. So from our experience, commercial financing allows us to be able to refinance that property without necessarily needing to butt heads with the banks. When you are looking to take on a project like this, just make sure that you consult one of us first, or one of your brokers first, to understand how much revenue do I need to make on this property to be able to refinance out. Because if you take $200,000 to build this, and then you're not able, the amount of income on the property doesn't meet the minimum debt servicing requirement to be able to pull out capital, it's going to be a pretty tough situation for you. So just understand, it might not make sense to put $200,000 or $300,000 into this project if the net operating income doesn't service the debt high enough to be able to pull out your investment. Or at least you might be leaving some capital in there, more than you maybe anticipated. This specific type of financing isn't new financing. This is something that has been around for quite some time. But as legislation changes, you're going to start to see more investors taking a look at this as a serious opportunity and an option to be able to continue to scale their portfolio.
Thanks for stopping by to another one of our video guys. Make sure you smash the like button, give us a follow if you aren't already following. Again, if you have any questions or comments, make sure you leave them down below or reach out to us directly. We always answer all of our DMs and text messages and call. All the information should be down below. Appreciate it.